Many people, I think, misread NAV premiums of Treasury companies as just a snapshot in time, not realizing that basically an effective Treasury company can earn that premium over time, whatever they're seeing today. So in days or weeks for faster growing companies, and then sometimes in months or even a couple of years for larger ones. You've put out a really nice framework around this, price over Bitcoin yield delivered, or PBID. Can you tell us why you created this framework and how it helps investors understand Bitcoin Treasury company valuations today?
Yeah, I love this topic. This is probably the most cutting edge topic that we can talk about. That for the most part, even Bitcoiners aren't thinking along these lines yet. Yeah, when people talk about Bitcoin Treasury companies, they tend to lock onto MNAV, the multiple to NAV, the premium that you have to pay, and commonly people are like, why would I pay 2x for Bitcoin? Why would I pay 5x for Bitcoin when I could just buy Bitcoin? And that's understandable, but I think the wrong sort of thought process there, because when you're investing in a Bitcoin Treasury company, you're investing in my view, in a productive asset. This is an entity whose goal is to increase Bitcoin per share, and it does that by leveraging capital market tools to sort of arbitrage fiat, raise capital, buy Bitcoin in a way that's accretive to shareholders, in a way that adds Bitcoin per share. And it does that as frequently as it can. And that compounds over time. And so what it amounts to is compounding Bitcoin ownership for investors. And yes, it's in a centralized entity. It's different from your cold storage Bitcoin. It's risk capital rather than, no risk cold storage Bitcoin. But yeah, people lock onto the MNAV side of things and seem to miss that, the price you should be willing to pay for a productive asset is the sticker price balanced out with how much productivity you expect to receive from that asset into the future. It's obvious to think about that in terms of, any traditional real world investment you might make in commercial real estate or in a manufacturing plant or whatever. But people seem to have not yet made that leap with a Bitcoin Treasury company. You're buying infrastructure that is productive. And so, there's a very helpful concept of days to cover, sometimes called months to cover, that Adam Back kind of put together, or was at least the person I first saw it from. And this was like 4 months ago that this, maybe 6 months ago now, that this concept was introduced. But it has some flaws and some limitations. The idea there is you can, based on your current MNAV, you can look back in time to see how long ago was my Bitcoin per share equal to today's Bitcoin per share divided by today's MNAV. Right? So like a fraction, how long ago did I have a fraction of my current Bitcoin per share that amounted to me growing into my MNAV today? So it's like kind of weird to explain it already, right? Like, and some of the problem there is that you have to go back far in time. So, with strategy, you need to go back like 2 years to find that point in time. And the world was pretty different 2 years ago for strategy. They didn't have preferred equities. They didn't even have Bitcoin ETFs live in the US 2 years ago. So I don't like how far back in time you have to look, and you're counting everything in that time period as relevant to your sample size going forward, which I don't love. And the other part of it is like, what does it mean to have a certain number of days to cover? It's an unconventional sort of unit to be using. And so the idea with PBID was let's take this concept of how long does it take to grow into your MNAV, but instead let's define the most recent period that's relevant as the period of time for our sample of Bitcoin yield delivered, and then use that amount of Bitcoin yield in that amount of time to project forward and say how many units of time does it take to grow into our current MNAV, assuming the same rate of Bitcoin yield delivery per unit of time as our sample. And I think, and then that standardizes the output, standardizes into a number in years, which I think is more helpful. It also has the massive benefit of lining up with a PE ratio, which is, in traditional equities, people are very accustomed to paying, what's your PE ratio for buying a stock? It's 20, 30, 40 PE ratio, 53 for NVIDIA. And that's what people are accustomed to. The PBID ratio amounts to the equivalent metric. It's not using income statement earnings and multiplying that for how many years of the same amount of earnings does it take to earn back your premium. Instead, it's saying based on the rate of value delivery through the balance sheet, how long does it take to earn back the premium you're paying? Same idea, different mechanics. And and then so that's the PBID ratio. It's log of MNAV over number of periods in a year times log of Bitcoin yield delivered in the most recent period. And so you can set that period to be a month, a quarter, a year, whatever it is, and it all standardizes to an output in years. So I actually don't know what it is right now, but over the last 3 months, strategy tends to be like 1.5 years to earn back the premium in that stock, or less. Right now, it's probably about 1 year, and that's because they've delivered year to date 26% Bitcoin yield, and right now they're trading, I think, at like 1.5 MNAV. So because it's compounding that plus 20% every 9 months, yeah, that comes out to about a year and a half. For Metaplanet, it's somewhere between a quarter of a year and half a year. And for Smarter Web, it's the same right now. It's somewhere between a quarter of a year and a half a year. And again, this is direct comparison to 20, 30, 40 years to earn back the premium you're paying for a traditional equity. And we're talking about half a year for a well-run Bitcoin treasury company. And that's why I think that there's more value in well-run Bitcoin treasury companies than any other public equities in the world at this point in time.
Wonderful, Jesse. This is great. I think it's a great metric and a great way to look at this and analyze it. But I do want to sort of ask you some follow-up questions here. As you said, it's a very interesting topic, so we could kind of dissect this. But like we said before, none of this is combative or anything like that. We just all try to get more educated and better here. So I'll start with this one. So you mentioned, with strategy, it now takes them about 1 to 1.5 years, to sort of grow into their MNAV. So let's use that as an example. If it takes 1 to 1.5 years for a treasury company to grow into their MNAV premium, do you think that could create some sort of material risk for investors? Essentially, you could argue that they're being asked to wait over a year to basically get full value for what they're paying today, during which time anything could happen. So it could be interpreted like, hey, trust us for a year, maybe a year and a half, and then we'll start to accrete some net new value for you. But of course, there's some risk in that, and investors ultimately need to be compensated for the risk that they take. Do you see this as a real risk, and how would you suggest that NAV premium skeptics think about this?
There's risk involved, and there's uncertainty with the model, and I think that's why there's such an opportunity. I think that's why there's this sort of mispricing of these equities in general, because that math is what it is, but investors collectively don't have a ton of confidence that it will continue into the future, and I think that's why MNAVs are as low as they are. Um, and I think it's some combination of uh, you have to think about your mix of global investors here. The vast majority think that, why would I pay 1.5x for Bitcoin? And that's as far as they think, right? That's probably 95% or more of global investors see strategy trading at a 1.5 MNAV and think that's clearly overpriced because I could go buy Bitcoin for cheaper. Um, and then there's a much smaller cohort. It's really probably 1% of investors who understand that what you're paying for is future Bitcoin yield. Yeah, and that what can inform your expectations about what that will be is how have they done in terms of executing on delivering Bitcoin yield in the past. And that's where the sample size of the most recent period becomes instructive but not certain, right? And so there's definitely risk going forward that maybe they were able to deliver yield up until this point in time and then they never will again, right? And so the market has to price in that possibility. But that's also true for any operating traditional equity. What a PE ratio is like, let's take a look at the last year of earnings and assume that we get that every year into the future. And that's a big assumption, especially when you're talking about 20, 30, 40 years from now. They might not even be a going concern. So there is risk there, but people are so accustomed to that, and that's just how the world works, that it doesn't feel that wild to be assuming the continuation of earnings, and it does feel highly uncertain to assume the continuation of Bitcoin yield, and partly for good reason, because the reality of it is it is reflexive, it is recursive. The ability of a Bitcoin treasury company to deliver Bitcoin yield is based on, in large part, on their MNAV. So, when MNAV is going up, it becomes easier and easier for a Bitcoin treasury company to deliver yield. And when it's going down, it becomes harder and harder. And because it's a very new industry, there's a lot of, the market's still trying to figure out what to make of these things. And there's a lot of oscillation, very rapid oscillation in terms of what MNAVs the market sentiment is willing to pay in order to own a slice of these entities that are aiming to grow compound Bitcoin ownership for their shareholders. So, like, all of that factors in, and the market comes up with a price of what it thinks is fair at a given moment in time in terms of MNAV for these companies. But I think, to me, the lion's share of what's going on is that 95, maybe 99% of investors only see that you're overpaying for Bitcoin, and they don't see at all that you're investing in a productive entity that's delivering Bitcoin yield. And so I think that lopsidedness is why these MNAVs are so low, when the math suggests that they should be a lot higher. And you should be willing to pay a lot higher MNAV if you expect plus 26% every 9 months for strategy. I mean, their MNAV should be higher. And, for Smarter Web, we've delivered plus 278% Bitcoin yield in Q3. And, so should we be trading at 1.44 MNAV, which is what we were trading at an hour ago? That assumes that we will only ever deliver a plus 44% Bitcoin yield forever. Meanwhile, we have delivered plus 278 this quarter. So, there's risk and there's no certainty. But a well-run Bitcoin treasury company, basically a company that delivers any amount of reliable Bitcoin yield into the future, is uh, an incredible value based on where MNAVs are and how quickly that compounding growth adds up.
Yeah, no, you're right, and I think we typically see these dynamics with new growth industries. You think about AI today, Nvidia investors are willing to pay up a huge premium for the future potential earnings. Not too sure what that industry or growth will look like. You think about Cisco back in the heyday, investors were willing to pay a lot for that too. So yeah, these dynamics seem pretty normal in terms of new growth industries. Maybe we'd push back a little bit on the earnings side. If I think about like subscription businesses or SaaS, a lot more predictable.
Yes, yes.
So,
Yeah, certainly a way more predictable, way more reliable input metrics when you're valuing a traditional equity. But the different thing is that you are relying on things being the same 20 plus years from now, in many of those cases, which is that's the one thing that is more uncertain with traditional equities than with Bitcoin treasury company, that you're only looking at a 2-year time frame, and things will probably be pretty similar 18 months from now than they are versus what they are right now. But yes, point taken. There's a lot. It's different because you are trying to assess the reliability of this strategy that has different inputs and has reflexivity and some recursive variables versus the tried and true operating model.
right, right. And you mentioned, right, that there, could be variance in terms of, what the yield, BTC yield might be from one quarter to the next. So those who might push back, and for investors who are thinking about sort of, is the current period the right one to use, most recent period, or should they kind of discount that in a certain way? I'm curious, what you might say to them, and maybe I could rephrase that a little bit because you know um, some of these companies, if we look at when a BTC treasury company first comes to market, their Bitcoin yield might be sky high, right?
Yeah,
If
yeah.
we use that, that's maybe not the appropriate metric or figure to use. And so, do you think there's a way to sort of discount it in some way, especially when we're looking at new entrants to the market or companies that are in hyper growth mode? Is there sort of a better way to approximate their BTC yield in the PBIT formula?
Yeah, it's a great question. And, PBID takes a stride forward in terms of balancing the MNAV versus Bitcoin yield. Um, and, in theory, a very small Bitcoin treasury company can deliver a lot more yield and should have a much higher MNAV. The sort of tricky irony there is that having a much higher MNAV allows them to execute better, um, in theory. The other sort of intangible that offsets this, I think, is like the vast majority of Bitcoin treasury companies never get their flywheel going. So there's like 200 Bitcoin treasury companies in the world, uh, and there's probably 20 that have like a solid track record of delivering Bitcoin yield. And that's being generous, frankly. Like I can only think of, maybe a dozen. And what that sort of implies is like the rest of them never execute enough to build a track record, like a solid track record. And that's the hidden reality, is like there's a lot of execution risk with an upstart Bitcoin treasury company. Everybody has the intention of becoming the next meta planet, and very few have all of the pieces that it takes to get on that path. In the UK, for example, so SmarterWeb is the first Bitcoin treasury company in the UK. and by far the leader, something like 10x um, larger Bitcoin stack than the next closest peer. When founder and CEO Andrew took his company public in April, that was the first Bitcoin treasury company in the UK. And then quickly, 25 companies popped up saying, we're going to be a Bitcoin treasury company in the UK. And they're going to copy the same regulatory pathways that Andrew trailblazed. And to date, 10 have bought any Bitcoin. So 15 never got to the point where, they, got through the regulatory hurdles and lined up investors and, got the infrastructure in place to actually buy Bitcoin. So right there, that shows you it's hard to execute. It's hard to get an actual Bitcoin treasury strategy in place. And a big part of that is like, can you convince investors that you have what it takes for them to invest in you? And for the vast majority, that answer is not really. 90%, something like that. And so when you talk about PBID for like a small, fast growing Bitcoin treasury company, what it doesn't account for is the intangible execution risk. And so you can be a tiny Bitcoin treasury company that owns one Bitcoin, and then you go out and you buy 2 Bitcoin the next day, and your daily Bitcoin yield is plus 200%, and you should be through the roof, valued based on PBID. But the execution risk, it says something else. So, it's not a perfect metric, but I think it is a step forward from just looking at MNAV and also from just looking at Bitcoin yield, because you need to have both. You need to account for both to see value. And also you sort of implied in there, like, ideally you would be able to know what the Bitcoin yield will be over the future period, right? Because that's what actually is relevant to investors, is what will, if you're doing it on a quarterly basis, what's the Bitcoin yield over the next quarter? But of course that's impossible to know. So the next best thing you can do is take the most recent quarter, and maybe you modify your assumptions about whether they will be able to do that into the future. Maybe you cut it in half and use that as your input to that metric. But all we have is reality.
Yeah, no, I think that makes sense, and you kind of see that's all these companies obviously trade in a public market, and so I think that's also maybe another reason why we see a lot of this volatility and price variations and MNAVs that aren't so consistent, because I, as an investor, might have one view in terms of how much a company might grow their yield versus someone else, and so I might be bidding at a different price than someone else. I also think here guidance could help too. I know Strategy has put out some guidance as well, and has typically outperformed that, and that's not really nothing new, right? Especially if we're comparing it to traditional industries. Companies put out guidance as well. Maybe they have to be careful in some ways in terms of what they're calling it, because they're using non-traditional metrics and stuff. But
Yeah.
I think they've been able to at least give guidance, not necessarily like forecast.
Yeah, that's a great point, and I actually haven't thought much about that, but that I think that the industry will head in that direction. And then, of course, like, there's a lot of uncertainty about what you will actually be able to do in a given period of time. And guidance, you need to be conservative. You need to deliver on that, and so that's a whole other can of worms in terms of execution risk. But the industry will probably head in that direction.
Yeah. Yeah, no, Jesse, you're doing great here with this. Had one more on this topic to kind of get your thoughts on this. So, you mentioned price to earnings, P ratio, but I'm curious, what would you say to someone who would push back and ask, how could you actually compare BTC yield to price to earnings, or PE, if it's not based on cash flow? And we know traditional investors, these non-Bitcoiners, are very much into their cash flow and earning some sort of payment back. Which companies, and maybe the reason for this, right, is that companies could theoretically pay that back to investors through dividends, through stock buybacks. As of now, I would say the consensus in the BTC Treasury company industry is that these companies won't actually sell their Bitcoin or pay back or pay Bitcoin dividends. So taking this view into account, how should we think about the comparison between earnings and Treasury company yields?
Yeah, I love that question. It's fun to think about. So what pops to mind is like cash flow is what matters on a fiat standard, right? Like what you need to do as an investor is generate cash flows to cover your living expenses and be above inflation, right? Like you have to outperform inflation, and that's what everybody's chasing. And they're printing more dollars, so there's abundance, right? Like you can earn dollars that are being printed, and then of course Bitcoin is a through the looking glass, total polar opposite world where there's scarcity. And I think that Bitcoin yield is the relevant metric on a Bitcoin standard where there's a finite amount of Bitcoin and when you're holding Bitcoin, you're accustomed to not getting a cash flow. You don't earn any more Bitcoin. What you earn is an increase in purchasing power. Your finite amount of Bitcoin grows in its purchasing power. And that's how the Bitcoin standard works. You don't get more of it, but each unit becomes more valuable over time. And so the goal is to grow your Bitcoin ownership, to grow your purchasing power that you control in Bitcoin terms. And the way that a Bitcoin treasury company seeks to do that is by growing your Bitcoin per share, growing your Bitcoin ownership. But at no point in there does that include cash flow, right? Like it's just not part of the Bitcoin standard way of things, of how the that monetary system works. So I guess that's what I lock onto there is like, dividends, cash flowing assets are a fiat solution to a fiat problem, and Bitcoin doesn't have those problems. You don't need to outpace inflation. You need to grow your purchasing power, and it doesn't require cash flow to do that.
Wow. No, Jesse, that's great. And I think probably one of the best explanations I've heard on this to kind of lay that to rest in terms of the it doesn't produce any cash flow. That's not what we're going for here. It's giving you something better. It's giving you an alternative, which is increasing your purchasing power, which is power, that's strength, that's optionality, right?
Yes.
So no, very I gotta do a little more thinking about that one. But that's really good.